Hello. In this video, we will be going over the lower of cost or market as it pertains to valuing inventory. So let's just go over just some quick review that in previous chapters we have learned about how to determine the cost of inventory, whether it's using your FIFO, LIFO, average weighted average, etc. And so that determines the balance that the inventory will go on your balance sheet, like what you're going to determine it's going to be on your balance sheet. And there are things that arise after you purchase or produce your inventory that might indicate that your company will sell your inventory for less than the cost. So it's for less than what's on your balance sheet. And that could be because of damage, it could be just deterioration, it could become obsolete, and changes in price levels. Like if the demand is not there, then that might mean that just the value of that inventory goes down. And so under GAAP, companies are required that to evaluate anything that's left on their balance sheet, so any unsold inventory at the end of each reporting period, and determine if they need to write it down, if the expected benefit of the unsold inventory is estimated to fall below cost, meaning below what it's currently on the balance sheet. And so that companies must make an adjusting entry. It's called an inventory write down to reduce that inventory if needed. And so there's two approaches to doing that, and it really depends on which inventory costing method is used. But the effects are the same in that either method will make you reduce your reported inventory in your balance sheet and you reduce your net income, and that's because your cost of goods sold is going to increase, which makes your net income decrease. And the measurement approach to determining if you need an inventory write down is based on the inventory costing method that a company uses. So if the company uses a FIFO, average cost, or basically any other method besides LIFO and retail inventory method, which we will get to in a later video, then they must use the lower of cost or net realizable value. And that's in another video I've gone over this approach. If a company is using LIFO or the retail inventory method, then they must use this approach. They must use the lower of cost or market, which is what we're going to go through in this video. So again, if they're using LIFO or the retail inventory method, they must use the lower of cost or market. And again, this is to determine if an inventory write down is necessary. So the first thing that you do is you look at the cost. So this is what's on your balance sheet currently, what your inventory currently, I'm writing backwards. Inventory, this is what your inventory currently is on your balance sheet, which is basically your cost, right? And you have to compare it against the market. And market is really the replacement value, the replacement cost, I should say. What would it cost me if I had to buy this inventory item today? That's my replacement cost. However, you have to also, you can't just look at the market at the replacement cost. The replacement cost cannot be above a certain ceiling. And that ceiling is the net realizable value. So remember, so the net realizable value is the selling price minus the cost you incur to sell, right? So it's whatever you can sell that inventory item for minus any cost incurred to prepare that item to sell, whether it's transportation or disposal, anything really. Assembly, anything, getting an item ready to sell. And you have to compare, there's a floor, and that is your net realizable value, which is your selling price minus the cost to sell, less a normal profit margin. So it says the market should not be less than the net realizable value reduced by the allowance for normal profit margin. So what you're going to do is you're going to look at your cost item, right? And you're compare it to the replacement cost. However, the replacement cost cannot be above this ceiling and cannot be below this. So you have to calculate the ceiling, you know the market price, and you have to calculate the floor. And whatever is the middle between those three numbers, then you compare that to the cost. We'll go through an example, and I think it'll make more sense. So again, these are just terms. The ceiling is the net realizable value, which is the selling price less the estimated selling cost. And the floor is the net realizable value minus the normal profit margin. Okay, so step one is to calculate your ceiling and your floor, and you're given the market price or replacement cost. So the general supply company has 5 inventory items on hand at the end of the year. The year-end selling prices and estimated costs of completion, disposal, and transportation, which are the selling costs, for each of the items are given below. The normal profit margin for each of the product is 20% of the selling price. These amounts are used to calculate the ceiling and the floor as follows. So the ceiling, right, is right here your net realizable value. So your net realizable value, if you look right here, is your selling price, which is 100,000, minus your estimated selling costs. So minus 15,000, I'm just going to take that, equals 85. So your ceiling is 85. Now, let's calculate the floor. So, right, so our ceiling equals 85,000. Our floor is going to be, so this also equals our net, which is our net realizable value. So our floor is going to be our net realizable value minus, and this is how you're going to calculate this, your selling price times your normal profit margin. Profit margin, which we are told is 20%. So here we have our net realizable value, which we've already calculated to be 85,000, minus our selling price. So again, this selling price does not take this into account. Do not reduce your selling price by the estimated selling cost. It's just going to be the selling price of 100,000 times, we're told that the normal profit margin is 20% of the selling price, which is why I'm multiplying it, times 20%. So this is going to equal to, let me try to make this, I'm unfortunately have to erase that a little bit just to make room. So the selling price is going to be, the floor is going to be the 85,000 minus 100,000 times 20% is 20,000, right, which is 65,000. So now we have our ceiling and our floor amounts. The ceiling is 85 and the floor is 65. That's step one. And then this is kind of showing it for each of the inventory items in the problem. We just went through A, but the same thing is being done for B, C, D, and E, and you can do that for practice if you would like. So, okay. So step two, right? So step one is calculate your ceiling and your floor. And step two is you're going to compare your cost, which is given to you, compared to your market. And your market is going to be either your replacement cost, which cannot be above the ceiling or below the floor. So whatever is the middle number between those three items is going to be your market or your replacement cost. So we're told our cost is 50. We're also told the replacement cost is 55. We calculated our ceiling to be 85 and our floor to be 65. Between the replacement cost, ceiling, and floor, we look at these three numbers and we say which one is in the middle. So we have 55, 65, and 85, right? And so 65 is going to be the middle number, and that's going to be our market. That's what's going to determine to be our market cost, and then you determine this versus the cost. So here we're going to look at the cost is 50,000 versus 65, and we say which one is lower? Well, the 50,000 is lower, and that's how you calculate the lower of cost or market for an item of inventory. So this this goes on to do the same thing for item B, C, D, and E. And when you're done with all your inventory, you look at your cost, which is 415,000 for all these 5 pieces of inventory, and you've done this analysis of the replacement cost versus the ceiling versus the floor for each of these items, and you pick the middle of those 3 numbers, and then you look at the cost versus the market and you determine which one's the lower of the 2. You can take all those and you add them up and you get to 387. Well, then you compare it to 415 versus 387. You say, well, 387 is lower. Currently, my inventory on my balance sheet is 415,000, and I need to reduce it to 387. So I have a $28,000 adjustment needed. I need to reduce my inventory by $28,000 because right now it's at 415 and it should be the 387,000. And just like with a lower of cost or net realizable value inventory write down, what you do is to write down your inventory here for 20,000, you credit inventory 20,000, and the other side goes to cost of goods sold. Unless you would debit a loss account instead of cost of goods sold if the write down is substantial and unusual, which if you had that, the problem would indicate as such. Similar to the lower of cost or net realizable value, you can also do the lower of cost or market at different levels of aggregation, meaning you can categorize it by, you can group the inventory by categories, by similar categories, or you could do it as an inventory as a total. But here we look at category, and item A and B is one category. So let's just say we have washing machines, right? And so we have this model and this model. And so we say, okay, we have a category of all of our washing machines and the cost for those is 150. Here for the market, we have to look at the total, the replacement cost, the floor and the ceiling in total for this category. And the way we do that is when you look at the replacement cost, you have to estimate. We say, how much do we think that in total all of our washing machines in our inventory is going to cost us if we were to buy it again today? So there's definitely an estimate component there, especially when you're grouping by category. And to calculate your ceiling, you need your net realizable value, which is your selling cost minus your estimated cost to sell. It's your selling price minus your estimated cost to sell. So you would have to look at how much do I think all of my washing machines I could sell it for. So there's a lot of estimates going on. They have to be reasonable. But then at the end of the day, when you do that, you look at your cost versus your market by category, and you look at the lower of the 2, and we say, okay, 150,000 is the lower of the 2 for category A and B. And then when we categorize inventory items C, D, and E, we look at the 2 items and we say the lower of the 2 is 247. And so in total, so we have inventory should be 397,000. It's currently 415. And so we would have to reduce our inventory by, how much is that? $18,000. So we have to reduce our inventory by $18,000, and we would do that using the same journal entry, except we would do this for $18,000. or that's if we use the aggregated level. Okay, let's go through an example. If I could just get to it. There's so many. Oh my gosh. Okay, there we go. The following information pertains to one item of inventory for the Forge company. And we're given these different pieces of information. And it says we have to apply the lower of cost or market rule to determine what this item should be valued at on our balance sheet. So the lower cost or market, well, we need our cost, which is, we're given our cost is $270. And now we have to calculate what is our market. Well, our market, we have 3 points that we need to determine. We need to determine what our ceiling, what our floor is, and what our replacement cost is. And whatever the middle number is, that's going to be our market cost, our market amount. So the ceiling is going to be the net realizable value, and that is going to be our selling price, $292, minus the cost to sell. That's going to be the ceiling, right? So minus 52, so that equals to 240. The replacement cost, we're told, is 225. So the replacement cost is 225, right? That's our replacement cost. And the floor is going to be our net realizable value minus the normal profit, minus our normal profit margin. And we're told in this example, the normal profit margin is 31. And so in the previous example, we were told the percentage of the profit margin as a percent, it was a percent of the selling price. In this example, we're actually just told the amount. So here we would do our net realizable value is 240 minus 31, which equals 209. So we're going to look at our 240, 225, and 209 and say which one is in the middle. It's 225. That's going to be our market. So that's going to be now our market. So now we have to look at our cost, which we're told is 270, versus our market, which we calculated right here, is 225. And we say which is the lower of the two, and it's 225. So, and here we go. This is just a write-up, but the answer is $225.